Hello, and welcome to Boni's Life, the channel where we dissect the intricate dance of global finance and digital assets. I'm your host, Boni, and today, October 16th, 2025, we stand at a precipice. The cryptocurrency market is not merely fluctuating, it is communicating a profound narrative of fear, opportunity, and structural transformation. Over the next 30 minutes, we will transcend the superficial headlines and delve into the granular data, the institutional chess moves, and the geopolitical undercurrents that are shaping the future of your portfolio. We will not just tell you what happened in the last 24 hours, we will illuminate why it happened and equip you with the intellectual arsenal to anticipate what comes next. This is not just another market update. This is a masterclass in navigating the most volatile and misunderstood asset class on the planet. Stay with me, because what you are about to learn will redefine your understanding of the crypto economy. The numbers themselves paint a dramatic picture. As of this morning, the total cryptocurrency market capitalization stands at approximately $3.887 trillion. While this represents a modest recovery, it comes on the heels of a cataclysmic weekend that saw the market hemorrhage approximately $460 billion, plummeting from a peak of $4.24 trillion on Friday to a low of $3.78 trillion. This was not a correction, it was a violent deleveraging event, one of the largest liquidation cascades in the history of this asset class, with nearly $20 billion in open interest vaporized from the derivatives market. Bitcoin, the market's bellwether, is currently trading at a precarious $111,422. It is the fulcrum upon which the entire digital asset ecosystem is balancing. The question on every investor's mind is simple. Is this the calm before a further storm, or the quiet accumulation phase before the next parabolic advance? To answer this, we must first dissect the fundamental drivers that have brought us to this critical juncture. The recent market turbulence is not a random walk. It is the logical consequence of multiple converging macroeconomic and regulatory pressures. The most significant of these is the stark warning issued just hours ago by the G20's Financial Stability Board. The FSB has declared that significant gaps persist in the global regulation of cryptocurrencies, with international implementation remaining fragmented, inconsistent, and insufficient. The FSB's Secretary General John Schindler did not mince words, stating, "These crypto assets can move across borders very easily, much more easily than other financial assets." This is not just bureaucratic jargon. This is a direct signal to the institutional capital that has been the primary engine of this bull market. The message is clear. The rules of the game are not yet written, and this ambiguity is a source of significant risk. For the multi-trillion-dollar pension funds, endowments, and sovereign wealth funds, regulatory uncertainty is the ultimate deterrent. This has injected a palpable sense of fear and has undoubtedly contributed to the institutional profit-taking we are now witnessing. The data from the Bitcoin ETF market corroborates this narrative of institutional retreat. On October 15th, we saw a net outflow of 921.36 BTC. This followed a massive outflow of 2,840 BTC on October 13th. This is a dramatic reversal from the previous week, which saw inflows of over $2.7 billion. The spigot of institutional capital, which had been gushing into the market, has been abruptly turned off. This is not a retail phenomenon. This is the smart money, the long-term holders, and the whales beginning to de-risk their portfolios. On-chain analysis confirms this, showing a pattern of distribution from long-term holders who accumulated at much lower prices. While this is a natural phase in any bull market, its timing, coinciding with regulatory warnings and a deteriorating technical picture, is a cause for significant concern. Compounding this is the shifting dynamic of safe haven assets. For much of this cycle, Bitcoin has been touted as digital gold, a hedge against inflation and geopolitical instability. However, in this recent period of market stress, it is traditional gold that has captured the safe haven bid. Gold has surged to a record high of over $4,200, posting a staggering 60% gain year to date. Central banks and institutional investors, wary of the depreciating value of the US dollar, are flocking to the oldest and most trusted store of value. This has created a capital drain from the crypto markets. as investors rotate from a nascent volatile digital asset to a proven multi-millennia-old monetary metal. Bitcoin's correlation with risk-off sentiment has broken down, and it is currently trading more like a high-beta tech stock than a digital store of value. The policy of the Federal Reserve adds another layer of complexity. The Fed has signaled a willingness to consider further interest rate cuts in response to a slowing labor market. Under normal circumstances, the prospect of cheaper money would be a powerful tailwind for risk assets like cryptocurrencies. However, the market is looking past the liquidity and focusing on the reason for the cuts: a weakening economy. The specter of recession is beginning to loom, and in such an environment, investors typically flee from speculative assets to the safety of cash and government bonds. The fact that mortgage rates have fallen to a one-year low of 6.2% is a sign of easing financial conditions, but this has failed to translate into any discernible strength for the crypto markets. The market is telling us that it is more concerned about a potential economic downturn than it is excited about the prospect of a few more basis points of rate cuts. Now let's turn our attention to the technical picture, because the magnitude of the recent price collapse was not just a function of these fundamental pressures. It was amplified by a series of cascading technical breakdowns. The chart of Bitcoin has formed a classic and ominous double-top pattern. The first peak was the all-time high of $126,123, set in early October. The second, lower peak was the rejection at approximately $116,000. The neckline of this pattern, the critical support level that, if breached, confirms the pattern's bearish implications, sits at $106,978. A sustained break below this level would open up a measured move target of approximately $74,000. This would represent a 34% decline from current prices and would undoubtedly trigger a fresh wave of panic selling and liquidations. Further compounding the bearish technical case is the presence of a large rising wedge pattern on the weekly chart. A rising wedge is a classic reversal pattern that forms at the end of an uptrend. It is characterized by converging trend lines and diminishing momentum, and it typically resolves to the downside. Bitcoin is currently testing the lower trend line of this wedge at the critical $110,000 level. A weekly candle close below this level would be a catastrophic technical failure and would lend significant credence to the bearish case. As the respected technical analyst Captain Fibik has noted, Bitcoin is still inside the rising wedge, and bulls are in control for now, but not for long. Momentum is fading, and once the wedge breaks, bears will take over with a sharp correction ahead. The internal momentum indicators are all flashing red. The Relative Strength Index, RSI, has collapsed from a reading of 72 on October 6th to its current level of 41. This represents a rapid and significant loss of bullish momentum. Crucially, the RSI is not yet in oversold territory below 30, which suggests that there is still room for further downside before the market becomes sufficiently washed out to attract aggressive buyers. The MACD indicator has also generated a bearish crossover, with its histogram moving below the zero line, a sell signal that often persists for several days or even weeks. Furthermore, Bitcoin is trading below its 50-day exponential moving average, which currently sits at $115,350. This level has now become a formidable resistance, and until it is reclaimed, the bears remain firmly in control of the intermediate-term trend. Ethereum's technical structure is a mirror image of Bitcoin's, but with its own unique challenges. ETH is facing a formidable wall of resistance between $4,200 and $4,400, a level that has repeatedly kept its upside attempts. At its current price of $4,053, it is struggling to hold the psychological $4,000 level. A break below this would likely see a swift move down to the next major support at $3,800. Solana, a high beta favorite of this bull cycle, has fallen 4.8% to $195.37. Its open interest has declined by 0.48%, and it has seen $54.13 million in liquidations in the last 24 hours. This is a textbook example of how altcoins amplify Bitcoin's directional moves, and it serves as a stark warning to those who are over-allocated to the more speculative corners of the market. So, With this confluence of bearish fundamental and technical factors, how should we be positioning ourselves for the next 24 hours? I have modeled 3 potential scenarios, each with a corresponding probability, to provide a structured framework for your decision making. Scenario 1. The bearish breakdown, 65% probability. This is my primary and most likely scenario. In this scenario, Bitcoin fails to hold the $110,000 support level and begins a fresh leg down. This would be triggered by a continuation of the current technical deterioration, further ETF outflows, or any escalation of the regulatory concerns we have discussed. The initial price target would be the minor support in the $108,000 to $109,000 range. However, the main target would be the double top neckline at $106,978. A break of this level would be a major technical victory for the bears and would open up the possibility of a move down to the psychological support at $104,000 to $105,000. In this scenario, Ethereum would likely test the $3,900 to $3,950 range, and Solana could see a drop to the $185 to $188 level. The optimal trading strategy here is to establish small short positions at current levels, with a tight stop loss at $112,500. If the $110,000 level breaks, I would look to scale into those shorts with aggressive profit taking at $108,000 and the ultimate target of $106,978. Scenario 2. The consolidation, 25% probability. In this scenario, Bitcoin manages to hold the $110,000 level and enters a period of sideways consolidation, trading within a range of $110,000 to $114,000. This would require a stabilization of ETF flows and a reduction in liquidation activity. This is a scenario for patient traders. The strategy here is to trade the range, buying at the low end $110,200 and selling at the high end $113,800 with tight stops and quick profit taking. Position sizing should be reduced as range-bound markets can be notoriously choppy and unpredictable. Scenario 3. The bullish reversal, 10% probability. This is my lowest probability scenario, but one that we must be prepared for. In this scenario, Bitcoin stages a surprise rally, reclaiming the 50-day EMA at $115,350 and pushing towards the $118,000 to $120,000 resistance zone. This would likely require a significant positive catalyst, such as a major institutional adoption announcement, a surprise positive regulatory development, or a massive short squeeze. The trading strategy here is to wait for confirmation. Do not try to anticipate this move. A long entry should only be considered on a confirmed break and retest of the $115,350 level, with a stop loss at $113,000 and profit targets at $118,000 and $120,000. Position sizing should be small, reflecting the low probability of this scenario. Given the overwhelming weight of the evidence, my primary bias for the next 24 hours is bearish. The optimal strategy is a defensive one, focused on capital preservation. I would recommend reducing overall crypto exposure to 30 to 50% of your normal allocation. Increase your stablecoin holdings to 50 to 70% of your crypto portfolio. For those with a higher risk tolerance, small tactical short positions with tight stops are warranted. However, the most important thing is to avoid emotional decision-making. Do not catch falling knives. Wait for the market to show you a clear reversal signal before you start to aggressively deploy capital. We must also consider the insights of some of the most respected minds in the industry. The legendary trader Peter Brandt has suggested that Bitcoin may need to undergo a significant shakeout before it can reach a new all-time high. He believes that while the 80% declines of previous bear markets are likely over, a test of the $50,000 to $60,000 range is not out of the question. His worst-case scenario, a drop to $74,000, aligns perfectly with the measured move target of the double-top pattern we have identified. This is a sobering assessment from a trader who has successfully navigated multiple market cycles. However, it is also important to maintain a long-term perspective. While the short-term picture is undeniably bearish, the long-term institutional adoption of this asset class continues unabated. Goldman Sachs is in the process of spinning out its tokenization platform, GSDAP, a clear sign of their long-term commitment to the digital asset space. JP Morgan and other major financial institutions are continuing to build out their crypto infrastructure. The regulatory clarity that is so desperately needed is, in the long run, a bullish catalyst. The predictions of respected analysts like Tom Lee and Arthur Hayes, who see Bitcoin reaching $250,000 and Ethereum reaching $12,000 by the end of the year, may seem outlandish in the current environment, but they are based on a sound understanding of the long-term network effects and the exponential growth of this technology. So, how do we reconcile these two seemingly contradictory narratives? The answer lies in understanding that markets do not move in straight lines. The path to a new all-time high is rarely a smooth one. It is often punctuated by violent corrections that shake out the weak hands, deleverage the system, and lay the foundation for the next sustainable advance. This is what we are witnessing right now. This is the crucible in which the next generation of crypto millionaires will be forged. Those who panic and sell at the bottom will be the ones who buy back in at the top. Those who remain calm, who follow their strategy, and who understand the underlying dynamics of the market will be the ones who are rewarded. In conclusion, the next 24 hours will be a critical test for the cryptocurrency market. The bearish case is strong, and the path of least resistance appears to be to the downside. However, we must also be prepared for the unexpected. The market has a way of humbling even the most astute analysts. My advice to you is this: be a student of the market. Observe, analyze, and act with discipline. Do not be swayed by the noise of social media or the fear-mongering of the mainstream press. Trust the data, trust your analysis, and above all, trust your strategy. The opportunities in the coming days and weeks will be immense, but they will only be available to those who are prepared. I will be here with you every step of the way to help you navigate this complex and exciting market. Thank you for joining me on Boni's Life. I'll see you next time.